Good afternoon to all of our ISM chapters, members, and guests, and a special welcome to our newest addition to the webinar group, the ISM Atlanta members who are joining us for the first time today. Please be sure to ask our speakers any questions using the chat or the Q&A tab. Now on to our presentation for today. Today's program will be on sourcing for logistics services, insights from the Logistics Managers Index, with our featured speakers, Dr. Stephen Carnovale. He's the Assistant Professor of Supply Chain Management at Rochester Institute for Technology, Saunders College of Business, and Dr. Zach Rogers, Assistant Professor of Supply Chain Management, Colorado State University. At this point, I'd like to turn the program over to the two of you.
All right. Well, thank you so much, Kathy, for the introduction and for the opportunity to be here. I knew for sure that we were talking to ISM New Jersey because we had talked about that a few months ago, and then they just kept getting added on, and I didn't realize how many until last week when I got an email from ISM Denver, because I'm a part of it, that said, "Hey, come see Zach Rogers talk about logistics." I thought, oh, I guess I should go to that. So thank you so much for having us. And I think we had a lot to talk about today. We have some new numbers from the Logistics Managers Index. It's actually, the report doesn't even come out until next Tuesday. So feel free to arbitrage the stock market, as you want. And yeah, we got a lot to talk about. So I can share my screen. Steve, I don't know if you have anything you want to add for the intro.
Nope, that ought to do it.
All right, perfect. Let me share the screen here. I'm used to working with like three, like it's so funny. I now can't work without like three monitors. So when I work from home, it's kind of limited. Okay. All right, well, hopefully everyone can see this. So like we said, today we're talking about sourcing for logistics services, insights from the Logistics Managers Index, and I put this picture up. I really like this one. It's from the New Yorker last month, and this was Santa trying to get everything here for Christmas, and it turns out he didn't. Now some of the big guys, they were fine, but what we're going to really see today as we go through the numbers is that there's been what we call a bullwhip effect in supply chain, where some things are coming in a little later than they were supposed to, and so now we have a really weird inventory imbalance where it's too much inventory some places, not enough inventory other places. Plus, I just like this because it shows a ship coming into the port near where you guys are, and that port is getting a lot busier. So let's get going here. For those of you who aren't familiar, the Logistics Managers Index is a change index that Steve and I, as part of a research team with our colleagues at Arizona State, Rutgers, and Nevada, which are Steve and I's alma maters, is a change index where we send out a survey to a few hundred people every month and say, in this director level above, so people who hopefully have a 20,000 foot sort of view of the company, and say, okay, things like inventory, warehousing, transportation, are they going up? Are they going down? Are they staying the same? You can actually see our survey right there. It's a pretty quick survey. And basically, as you read this, any number that you see that's above 50 means we're seeing growth, and how far above 50 it is means the rate of growth is greater. Any number below 50 is contraction, and the further below 50 it is indicates greater levels of contraction. We have over 6,200 responses for this in the 5 years. The 5 years we've been doing it since 2016, and you can see if we're just looking at it. If we're just looking at, kind of what happened over the last year, we have been in the 70s now with this reading in January. We have been in the 70s, and we would consider any reading over 70, we would consider really significant rates of growth. We've now been there for an entire year. And really, if you go back to last September, we've been close to the 70s. Now, we saw a dip in December and January, and that's the normal sort of dip you would see as supply chains reset in December and January, and you run down your inventory. Interestingly, though, we're not seeing that this year because we're not really running our inventories down the way we thought we were going to, and capacity remains very, very stressed. I see we have a couple chats, so maybe I could just, oh, okay. All right, just making sure those are, I'll hold my chat box down here. So if anybody has any questions, and you want to throw a question in the chat, please feel free. My students, when I teach online, way more likely to talk if there's a chat box. I don't know if they're nervous or what, but if we will have the chats up in case any questions pop up. The last piece here is that generally the LMI has been a really strong indicator of future economic activity. You know, I know right now some people are worried about a downturn and the stock market's down because it turns out that Bitcoin wasn't the bulletproof plan, and pictures of apes or whatever, not as solid as people thought they were. But if you look at the fundamentals, and that's what this shows, the LMI is the fundamentals of the economy, because if we're going to sell something, well, first we got to move it. We got to have it in inventory. We got to have it on the shelves. And we're still showing pretty good rates of growth. And we're actually working on a different sort of project using this data that shows, if you want to know what's going to happen in terms of retail sales or the stock market or unemployment in February, look at the LMI in January. And if it's going up, it's usually a pretty good indicator. Steve, you want to jump in on anything there?
Yeah, I think the point to note regarding the LMI, generally speaking, is that when you look at it relative to other measures, it provides a nuanced but really precise view on the things that matter with respect to future economic activity, to Zach's point. So the fact that we're looking at inventory levels, capacity of warehousing, and pricing, we're kind of getting a pulse on not just what has already happened, which is implicitly baked in. We're looking at what might happen, and it's the pulse of the crowd. So a number of different methodologies have come out that have been really useful. This leveraging the crowd, multiple different perspectives from how many are we up to our panels, Zach? Are we up to the couple hundred at this point?
Yeah, so we have, there's thousands of different people who take this sometimes.
Yeah.
But yeah, we have a few hundred every month.
And so that's the thing, right? You get a few hundred different perspectives from different, levels of experience, rather than one analyst at an equity firm saying, buy those apes with that NFT or that Bitcoin. So yeah, no, I think that's the point I would accentuate. I have a couple other things as we move forward, but right now I hit the nail on the head.
All right, perfect. So if we kind of pull back and we don't just look at just the overall LMI, because the overall LMI, we're combining all these metrics together. But I think it's interesting, especially as we're talking about sourcing for logistics services, to understand where we are, all right? And then we'll talk about how we got there and where we might be going forward. But let's talk about where we are right now. In this chart that we put together, I think does a decent job of showing this. So this is logistics price and capacity during COVID-19. So if we go back, now it's crazy. Now it's been 2 years basically, because you got to start in February, because that's when we really start seeing the shocks coming out of China. I mean, it was there in January, but when it hit us was really February. And I think it's so interesting. So this purple line is aggregate price. So all of our logistics prices, so all of our price indices, so inventory, warehousing, transportation, all put together. And then this blue one is all of our capacities put together. So how much capacity is available. And anything, that gray line there is our break-even point. So anything above the gray line means growth, anything below means contraction. It's so interesting, I think, to look at what's basically happened over the last 2 years. So we can kind of see, all right, there's February, and we were 2.9 points apart. So that's solid rates of growth for capacity, moderate rates of growth for price. Everything looked like it was pretty good. And then we go to March, and this is interesting, by the way, I think, when we see the sudden spike in price and this dip in capacity. And this sudden spike right here, this was like, oh no, we all have to run to Costco and start pushing old people out of the way to get toilet paper. That's what this was right here. That one little, oh shoot, push everything forward. And then we see this lockdown. And this is the only time in a long time that we've seen capacity growing faster than price. And this was really just in April. That 1 month, remember how weird the first month of COVID was, where it was like, oh, we're inside, we're learning how to cook, get into a hobby. We'll watch a 10-part series about how crazy Michael Jordan was and how long he held on to grudges. That was this. And then after that, it started to be like, okay, well, we can't just sit inside watching Tiger King forever. We gotta open up a little bit. And so you see, over time, we slowly have this sort of growth in price. And what I want to be really clear about here is that anything over this line is expansion. Anything under is contraction. And so it's not about like if you look here, say going from September to October, and you see the blue line go up a little bit, that doesn't mean, oh, some capacity came online in October of 2020. No, that means that this, we were always going down. It's just that the slope wasn't quite as bad. The slope wasn't quite as negative in October as it was in September, but anything below the line means we have less available basically than last month. And so I think it's so interesting to look at this. Contraction has been decreasing since May of 2020. And now we're in January of 2022. So now we're more than a year and a half where the rate of growth basically for warehousing hasn't been able to keep up with demand. Now, of course, there's more warehouses now than there was in May, but it's that supply and demand are getting further and further apart. And they have been basically for a year and a half. And, we went from 2.9 points apart in February of 2020 to where are we now? About 127.4. Is that what that is? 127.4 points apart. So it's like 130 point swing, 130 point swing in 2 years. And as you would expect, if we have capacity that low for that long, we're going to really see high rates of growth. And again, we would say anything over 250 is a significant rate of growth. And we've now been over 250 every month since I think March of 2021. And so we've had 11 months at this really, really crazy rate of growth.
And the interesting thing about that too is, the thing that I look at every month for our report is the warehousing. And so we've had a firsthand view on the dynamics basically of two things. One, how people have responded and potentially will respond to the shutdowns and the economic chaos that happened. And the other thing too is the way in which habits will change in terms of consumption. So when initially this all happened and we saw the shock that occurred to the system, it made perfect sense, at least a couple months after, that warehouses would fill up because inevitably people were buying things online. So the trend towards e-commerce, which had already been accelerating, was completely there. But the interesting part too is if you remember in the beginning, certain industries really read the situation wrong, and rather than increasing capacity, they shut it off because they thought it was going to demand was going to ebb or decrease. And if hindsight being 2020, was that rational or not? To a certain degree, yeah. If we're talking about 2 weeks to stop the curve or 10 days to stop the curve, yeah, maybe it makes sense to pull back on capacity a little bit. But if you think about the shift toward consumption and online purchasing, it's a whole different market. So that's the one thing. The other thing is if you look at, and you can go back and look at every single month of all the reports, warehousing in particular, there used to be this kind of seasonality to it, and there'd be like a 2-month lag lead relationship where if there was if the capacity and the pricing were off, it would probably catch up in a couple of months. We've been saying in the reports, we're hoping for this imbalance to catch up now for 26 months. It just hasn't. So it's been this 130 point swing in the difference between pricing and capacity. It's really not terribly surprising in hindsight, particularly when you look at everything we've seen. It's pretty crazy.
Yeah, no, that's absolutely right. And I actually have some numbers I could show here related to the e-commerce thing. Before I get into this, though, I saw Sheila, you have a question about how do the correlations work. So she said, if the January 2020 index is 70, then economic activity will be strong for 6 months. So really, we only looked forward, and Steve, you did the analysis, so you probably remember a little better than me. We looked forward 1 and 2 months. So we looked at, okay, if it's strong in January, what happens in February and March is kind of what we had looked at. Now, we also do future predictions, and that'll be our last slide, actually. We'll show you, okay, what do our respondents think is going to happen over the next 12 months? And it's still pretty strong over the next 12 months. And they're pretty accurate, and again, it's like Steve was saying a minute ago, you harness the power of the crowd. 2 heads are better than 1, 200 heads are way better than 1. And that's some the people who were contributing to this month's report. And so we can kind of see a little bit what's going to happen now. Did they predict March 2020 correctly? No, No, they missed on that one. But ever since then, they've been pretty close. So Sheila, hopefully that answers your question. Okay, so let's get to what some of Steve was saying about e-commerce activity and why we're seeing this crazy crunch on capacity. So one is we're trying to catch up from when people stopped. Basically, we turned the spigot off last March and April, and I think some people are thinking like, okay, well, how come we're not caught up yet? Why have we not caught up? We were only really totally, flattening the curve for a couple months in earnest. And then we were kind of like, well, I'll wear a mask. I'll go outside. It'll be fine. How come it's taking us so long to catch up? There's a couple reasons. One is consumer patterns really changed. Consumer behavior really changed. So if you look at, say, 2019, in 2019, e-commerce went up by 15%. And that's like the normal rate of growth that we would expect every year is about 15%. Well, in 2020, we're all stuck at home. It went up 40%, 45% in Q2, but I think overall it was 40%. And so think about what that means. If you're having something delivered to your house, now it's not just, well, we have to send something from a distribution center to a Walmart, for example. We'll send it to the store, it'll sit on the shelf, and then you'll drive and you'll be your own last mile. Well, now no one's, very few people last year being their own last mile. And so we have to deliver to your house. But on top of that, it's not just the extra driving, it's the warehouse piece of it. Because Walmart wasn't really making deliveries from their traditional distribution centers. As we, expectations change for consumers, we think, hey, this shouldn't be 3 days for me to get something. It should be like 3 hours. I should be able to order something while I'm at work and it should just be at home, when I get there tonight at 5:00. And so where warehouses are has really changed. If you look at commercial real estate, over 50% of the new leases from last year were sites that were less than 50,000 square feet. Now that's relatively small. When I was at Amazon, the warehouse I was in was 500,000 square feet, right? That 50,000 is fairly small. Why is it? Well, it's because we're trying to get as close to consumers as possible to get this really quick rate of delivery. And so a lot of times you're sort of taking what's there, and where we're getting warehouses tends to be very, very expensive because we're looking for all this sort of urban area. Okay, we're looking for all these urban spaces or suburban spaces, something that's really close. When I worked at Amazon, the warehouse I worked at was out in the middle of nowhere. I was late for my first day at work because there's just wild bulls just walking around in the road. Today, if I order an Amazon package, there's a site 10 miles away, not even 10 miles, 10 minutes away. And it's just like in a suburb across the street from a mall. And so it's really changed sort of the intensity of logistics services, logistics capital needed. And part of that has been spurred on by e-commerce. Now, what's interesting is the way that e-commerce has grown has been different. You would have expected, like everyone was pretty disappointed this year because Thanksgiving weekend, so Black Friday and Cyber Monday, if you look, digital sales were down in 2021, right? It went from about 25 billion last year to now less than 20 billion. So that's the first time this has ever gone down. And if you look, Prime Day didn't grow by that much either. Now, Singles Day in China, that's a whole other thing. And I just put that in there because I think it's crazy to look at the scale of what's going on over there. Now, they have changed the rules on Singles Day. This is now like Singles. This is really like Singles Week, honestly. And also sometimes their concept of what a delivery is different. It's not necessarily it's at your house. It's, well, we filled up the locker on the corner of the street and then the locker was full, so we just put it in front of the locker on the sidewalk, delivered. So I mean, it's a little different, some of these numbers, but still, I think it's interesting to see that there was a conscious effort made by a lot of companies, and here's a headline about it. Amazon was really trying to smooth out we're trying to make Black Friday the first Monday in October. And there was Black Friday level deals coming out from companies all over the place because we're trying to get away from this idea of like, oh, quick spike, come back down, and really want to smooth it out. And that's why the header on this slide is Black Fall. It's way less about Black Friday or Thanksgiving weekend or any of that stuff. Now it's trying to sort of smooth this out. And there's a couple reasons for that. One was because there's just, like we saw a minute ago, there's no capacity. No, there's no surge capacity available. You can't just, okay, well, we'll run a bunch of overtime and have enough trucks for everything. There's not enough overtime in the world to deal with the increase that we've had in e-commerce. And so it's really kind of changed the model that people think with. And here's what's interesting. Even though, all right, Thanksgiving weekend was down, Prime Day wasn't up by that much as we would think, we still had an 8.5% increase in consumer spending during November and December, like holiday shopping times. It was still up by 8.5%. And I think it's really interesting how companies are having to deal with this, and that's smooth out demand as much as possible. And we're going to see the impacts on inventory when we get to the next slide here. So companies really put a lot of effort into building up inventories this year. And it was to get away. Remember, like everyone was so worried, like, oh, Christmas isn't going to happen. We're not going to have turkeys for Thanksgiving. We're not going to have any toys. And it turned out, oh no, we pretty much had everything. Now, who had it was mainly the big guys, right? Like Walmart, Target, Costco. They were all chartering their own ships to come across the ocean. Coke did too. Although Coke ended up getting like a tanker. Coke got something you would like ship like coal or stuff in. So I don't know. Hopefully it was just the aluminum they were shipping and not the Mountain Dew. But it was really interesting. The big guys were able to spend a ton of money and get things on the shelves in times, right? We were able to get things places quickly because they had the capital to do it. I mean, look at this headline from Walmart. U.S. inventory was up 11.5% in the fourth quarter because of the expectation of sales. Think about Walmart. Walmart is the most JIT retailer on the planet. And for them to have it up 11.5% is kind of crazy. By the way, I love this picture. This is just the picture they used in the Wall Street Journal. I love this picture because it is exactly, clearly these people are two parents back to school shopping. And this is exactly how back to school shopping goes in my house. My wife has a list. She's getting everything off the shelves and I'm sort of helping. I'm really doing emails and pushing the cart, but I'm there. It's solidarity. Interestingly, the smaller ones like the Gap, Aeropostale, Abercrombie and Fitch, basically if you were somewhere that I thought was a cool place to buy a shirt in high school, you had big problems getting stuff over here in time. And then of course for this is just a report from today. The chip thing is still going, right now. I think a thing just came out from the Department of Commerce that said right now companies have 5 days of chips on hand. Normally we should probably have more than a month of chips on hand. So it's really interesting. And we're seeing this dichotomy and I'll show you when we get to the upstream downstream split in a minute. There's parts of the supply chain where we have a ton of inventory. And because we have a ton of inventory, there's no available capacity. We have other pieces of the supply chain where we don't have nearly enough inventory. And it's because we don't have capacity. And so there's this really sort of haves and have-nots thing that's happening in the supply chain that I think is really, really interesting. Sherry, I saw you had a question. Do you see any positives in the future of supply chain and how soon in certain areas or across the board? So that's a great question, Sherry. And we will get to the future stuff at the end of our presentation. The one thing I think that I would say, and Steve, tell me if you agree or don't agree. I think we've probably hit the bottom in terms of the mismatch between supply and demand for logistics services. What used to be for probably the last year until about maybe I'm going to say October, when we were asking our respondents, hey, transportation capacity, warehouse capacity, where do you see it going? We were getting negative numbers the whole time. It was, it's going to be down again in the next 12 months. And really since the middle of fall, we have started to get some optimism in terms of, there will be more warehouses over the next year. There will be more trucks over the next year. Now, those are tempered. Like I said, 50 is the cutoff line. We're getting numbers pretty much all in the 50s. I think maybe we got a 61 for transportation one time, but mostly we're getting numbers in the 50s. So we're predicting moderate rates of growth. the issue is that prices are going to remain high because we're so far behind the 8 ball in terms of moderate rates of growth. Moderate rates of growth are what we should always have for the most part, because we always, the economy is usually moderate rate of growth. We'll grow 2-3% a year. Okay, we should have 2 to 3% capacity every year. The problem is that right now the mismatch, instead of being, instead of us starting at the same plane, like, oh, it's 0-0, it's like, the other team already has 3 touchdowns. And if it's 0-0 or they score, we score, they're still going to stay 3 touchdowns ahead. And so moderate levels of growth, it's better than no growth, and it's way better than contraction, which is what we saw for the last 2 years. But it's going to take a while until we sort of get to where we need to be. Does that kind of answer your question, Sherry? And Steve, I don't know if okay, perfect, good. And Steve, I don't know if you feel the same way. What do you think, Steve? Do you think we've hit the bottom in terms of the supply demand mismatch, or do you think this hole goes lower?
I think it could go lower, but I do think that we've hit a bottom, and now we're starting to bounce into a different direction, because what you're seeing in a lot of anecdotal ways is vertical integration with logistics services, right? Mm-hmm. It's a thing that we got away from for a number of years, but now it's like a pendulum. We're going back to it. For all the purchasing folks in the room, it's the way that centralized purchasing versus decentralized purchasing, right? We go, on the one hand, we say, no, we need to control locally and have distributed control. And then, no, we need to bring it back and have everything centralized. It's kind of the same way with contracting for logistics services. The explosion in 3PLs, late 80s, early 90s, companies don't need to worry about that now. And yeah, to a certain degree, they don't, because it's not their forte. But, I've talked to a number of people in the logistics industry, and FedEx really wasn't terribly concerned with DHL, or DHL wasn't terribly concerned with UPS. They were all kind of worried about Amazon because of that vertical integration, because of the buildup of their own capacity, not actual capacity in the sense, although yeah, but their capability to be able to transport products. So, I think we probably, like a year into this, reporting on this stuff through the pandemic, we're probably like, yeah, we're close to the bottom. So I stopped saying that because, I think there's obviously further mismatch to happen. But the other thing too is that we're with warehousing, at least, and with transportation, we've been playing catch up. To your point, Zach, we've been leapfrogging one another. So the other thing too that's interesting is that we're in January now. We've got the returns that are going to be coming in, and those are going to be reflected in terms of how much capacity that's eating up. So I don't know if we're going to be talking about that explicitly, but
yeah, no. Well, there'll probably be about $125 billion of returns this month, and yeah, and the reason for that is, and I think I had this as a bullet on the last slide, but we didn't talk about it, is that returns for e-commerce tends to be 2 to 3 times higher than returns in person. Because in person you can like, oh no, this shirt fits. this is the type of blue I think it is. And online you don't really get that. Plus, you have people who do online shopping just specifically, with the idea that they are going to do returns. I taught an MBA class in December, and we were talking about some of this stuff. And I said, does anybody ever buy 2 pairs of shoes, maybe a 10 and an 11, and then you're going to send the other one back? And a woman in my class was like, actually my brother's getting married. It was like right between Christmas and New Year's or something like that. So my brother's getting married, and so I actually just ordered 9 dresses for the wedding, and I'm going to send 8 of them back. And so that's the kind of stuff which I was very impressed by that. That just seems like a lot of effort that I wouldn't have been willing to go through for my brother's wedding. But so that's why you see that the really high rates of returns. And let's now get into this. Let's now get into, okay, what's happening with capacity? What's happening with capacity and inventory? And I put this little picture together for us. And the yellow line here is inventory costs. Gray is inventory levels, and green is inventory capacity. And you see something weird here. So again, this is going back 2 years, the last 2 years of inventory and warehousing metrics. And again, you look 2 years ago, very different story. capacity in the 50s, inventory levels in the 50s, very moderate rates of growth, close to no change, basically, which is usually what you would see in January, very low rates of growth, and costs were 66. Then you go forward, and you see some really interesting things. The first thing is, one, capacity for warehouses has basically been down since the pandemic started. In August of 2020, this is the only month we've seen growth this whole time, and it was a 50.5. So that's basically like, we have 200 people taking the survey. If probably 5 more people would have said, no, it's contracting, we would have been back at a 50. But we saw just a shade of growth there. But other than that, it's been contracting. Well, what's happened with that? I think it's so interesting because normally inventory levels and inventory costs kind of move together, and you can kind of see how they mirror each other. And then we get to last fall, or I guess 2 falls ago, like October, November 2020, and we started to see that really split apart. And this is when we had supply chain shortages. That's when that really started to be written about for the first time. So people are like, man, we're kind of running out of stuff. And it goes back to what Steve said a minute ago. At the beginning of the pandemic, it was like, oh, we need to tamp down on supply because demand's going to be down. And then it turned up, demand went up like crazy. And so then we saw this sort of gulf emerging between inventory costs and inventory levels. And that's so weird because it seems like, well, if we have less inventory in hand, why is it getting more expensive? One is, okay, maybe more expensive warehouses. Here's the other thing. It's velocity. Inventory velocity was up significantly over the last year. Basically, stuff would come in and then it would go out the next day. Like, it was really hard for companies to build up sort of the cache of inventory, the safety stock and everything that they normally might have, particularly in some industries like semiconductors or cars. I don't know if anyone is like in the chat or anything has tried to buy a new car in the last year, but it's pretty difficult. Ford has a whole Kentucky Speedway right now is just full of old unfinished F-150s that are just missing the chips. Basically, they have the body but not the brain, and so that's going on all over the place. And so I thought it was really interesting that we had this big gulf for a while. Here's what's funny. This was kind of, every time I've ever talked about this before, that's where the story ended. Well, inventory is going through really fast. Inventory to sales ratio is down, but it's just because sales is up so high. Look at this. In the last 2 months, we went from a 58, I think is where we were in November, to now we're at a 71. This is the first time in 4 years since March of 18 that we've seen inventory above a 70 in terms of rate of growth. Remember, we say 70 is a significant rate of growth. And this is actually the second highest reading that we've ever had in the 5.5 years we've been doing this month. Okay. It's bizarre, though, that's happening in January. I mean, look at the previous 2 Januaries, we're at 54. Here we were right at about 60 maybe, and now we're at a 71. That is so weird. January and February, that's normally like, I don't know if anyone else, I'm doing this year, is doing the dry January, where you're like, I got to detox, man. I got to get all this stuff out of my system after the last year. Supply chains kind of do the same, and it's miserable. Supply chains kind of do the same thing. Supply chains do the same thing where it's like, all right, we're going to reset the end of the year. Holidays are over. And instead we're seeing the highest level of inventory growth that we've seen in 4 years, and the second highest one that we've seen in the history of the index. And I think that's really interesting. And it shows a couple things. One of them, and we'll get to this a little more on the next slide, is I think we're seeing a bullwhip effect where you have small, and the bullwhip effect comes from, if you I don't have a whip, but I've seen Indiana Jones, and he moves his wrist like this a little bit down here, and then there's huge oscillations out at sort of the upper pieces of the supply chain, the upper tiers of the supply chain. And that's what we're seeing here. There was these movements in demand, and then we just started really cranking out the inventory. Companies were like, gosh, I'm placing an order. I don't know if I'm going to get a ship in, if I'm going to get on a ship for 3 months. And so instead of I'm going to place my monthly order from my vendor in China, I'm just going to place 3 months I'll order 3 months at once, because who knows when it's going to get there. And people started doing that all over the place, and we were doing rush orders and all that stuff. And now it's funny, if you look at the Port of Los Angeles, and I actually have the numbers for the Port of Los Angeles. Let me move that up so you can see that really quickly. Look at this. This is the email I got from the Port of Los Angeles today. This is, how much is coming in. It's up 53% in the first week of February from where it was last year, 21% next week. And so we have this crazy level of inventory that's coming in that we wouldn't normally see at this part of the year. And a lot of this is stuff that was supposed to be here for Christmas or holidays or whatever, didn't get here. And we're having this really huge buildup, I think, of inventory. And we're going to continue to see, people thought, well, Chinese New Year's February 1st, maybe we'll see a break. It doesn't seem like we're going to see a break based on sort of the tea leaves we're reading here. Steve, we got a couple questions in the chat, but I don't know if you want to jump in on any of this stuff first.
Nope. Yeah, I think you hit the nail on the head. I think the only other thing for us to think about is rather not is, but will the lagging leading type behavior that happened previously, will it get normalized now, since it's just, we've shifted how we're buying, where we're buying. And, the one thing I did want to say, it's funny, you talked about the lady doing 9 dresses. I remember reading an article when Macy's went on the omni channel, or turned their supply chain into an omni channel. And they were having that problem back in like 2013, where people were just, they called it the bedroom dressing room. They'd order $400 worth of stuff and return 300 of it. So yeah, I mean, you've got that going on, increased e-commerce. I don't know, it's kind of chaotic. It's going to be fun to see from our standpoint what happens, but
yeah, no, it's great for Steve and I, because we used to work in this industry and now we just talk about it. So we got a couple questions here. And Ryan, I see yours. I'm gonna do Maria's first, and then Ryan will come back. Okay. So Maria said, with the new facilities popping up everywhere, add to working capacity. Absolutely. Yeah, absolutely. And you've seen a real big investment. Everywhere there's basically flat ground here, which I live in Colorado. I mean, I can see the Rocky Mountains out my window, so there's not flat ground everywhere, but everywhere there's flat grounds here, where it seems like warehouses are going up basically, and they're converting old office buildings and all kinds of stuff are being converted to sort of light industrial warehouse space. The issue, Maria, is that we can't build those quick enough to keep up with demand. All right, so it's kind of like, if you think about, okay, here's the demand for last mile delivery and all the things that we need more warehouses for, and just inventory coming in. And then here's warehouse capacity. They're both going up. It's just that demand is going up at a faster rate than supply. And so that gulf between them continues to grow. Now, like I said, when we look at sort of future numbers, projections, over the next 12 months, our respondents do think that we will start to see supply catch up to demand. So we will start to have more capacity sort of come on and catch up to demand. It's just, like I said, we're a ways away. So Maria, hopefully that answers your question. And that's a good question, because yeah, it's weird. It's so weird for you to think like, oh, perfect. It's so weird to be driving. And I do this when I drive down I-25 right here. I see new big box warehouse stuff open up all the time. And yet those numbers keep going down. It's just because demand is going up so quickly. Ryan, your question was, what's the lack of labor? So I wanted to save you for a second, partly because it so much has to do with this slide right here. Okay, when you talk about what's the lack of labor. So it's funny because you see, okay, we're up 21% is what's supposed to come in next week. 53% is what's supposed to come in the week after that. Week 4 of this year, it was down 4%. So what does that mean? Does that mean that it was a slow week at the dock? No, but actually COVID has hit the Port of LA really, really hard in the last couple of weeks. And so their processing capacity is way down. It's funny when you look at, right now it's saying 140,000 TEUs are to come through in 2 weeks. They're not going to do that. It's going to be lower than that, probably. That's what's booked. And then they're not going to have the capacity to do it. And it's why you see numbers like this down here, average time waiting berth. So not even like we're being unloaded, just like until we can even start thinking about being unloaded is 18 days. So we're just sitting in the water now, a little further away from Los Angeles than we were before. Yeah, it didn't look great. Some pollution. I think somebody hit a dolphin. I really actually think that's what flipped it for some people. We're sitting there for 18 days. just sitting there, just waiting. And that's a lot because of, one, the backup, but also the processing capacity of the Port of LA is sort of stressed. Right now, ports in places like that, it's like, I don't know if you've been following what's happening right now with, say, hospital staffing. We have a big shortage of nurses and doctors right now because they've been running at 100 miles an hour for almost 2 years, and people are just dropping out. It just burned out. Like, I'm gonna do something else where it's not so crazy. We're seeing the same things happen at intermodal hubs, at ports, all over the place. People are like, we've been going like crazy since last fall, the fall of 2020. And we're going to be busier than ever this week. And so labor absolutely is having an impact on it. The other place you see it, Ryan, is in trucking.
Yep.
It's really interesting. If you look at trucking employment, so driver employment, any route underneath 400 miles, okay, so 0 to 400 miles in a day, that's actually up significantly from where it was pre-pandemic. And the reason for that is, well, there's a couple. One, there's way more of them because of that's what e-commerce is. That's what last mile delivery is. It's less than 400 miles. And then also, drivers have more leverage now than they've probably had since the 70s when it was a big union thing, pre-deregulation. And so now if you have the choice, well, gosh, I could do this 2,000-mile route where I'm home on the weekends maybe, or I could do this route where I'm home every day, see my kids, because honestly, signing up to drive a route that's 2,000 to 3,000 miles, it's like, do I want a divorce and diabetes? Is that what I'm looking for? And most people say, no, I don't want that. And so that's the piece where we're really missing, Ryan, where we're really missing the labor is in the long haul stuff. And that's why it's been so hard for certain parts of the country to have supply. Like, there's the sort of pieces in the middle of the country where like they don't have gas or something. And it's because we don't have that long haul labor sort of help out. Now here's what's interesting. We're adding all these different facilities and stuff like Maria I think pointed out. That has been a driver of employment growth. If you look at the December report and the November jobs report, both of those were a little lower, I think, than everyone was hoping they were going to be. Here's what's interesting. In November, 10% of the jobs added in the US were transportation, distribution, warehousing jobs. In December, 25%. Okay, remember it was like right around 200,000, 220,000 jobs in December. 50,000, more than 50,000 of those were transportation, warehousing, distribution jobs. And so it's really interesting. We are adding jobs. Like, it is growing really, really quickly. And, if you think about it, why are people not working at McDonald's anymore? Well, I can start at Walmart 40 hours a week for sure in a distribution center and get $20 an hour. So we do see a movement to certain parts of the supply chain, distribution centers, short haul trucking. It's the other pieces, the ports, the intermodal hubs, the long haul trucking, where labor has been an issue. So
that was
Ryan,
the thing, Zach, that was the thing that wasn't really well thought out, in my opinion, with respect to when the ports were increased in terms of 24 hours and staffing. It was the middle mile and the warehousing capacity that was basically not considered. It was like, yeah, we're going to crank up the faucet and, attach this fire hose to a garden hose and hope a coupling that's a piece of duct tape and some spit connects it together. You're exactly right. It was that middle mile piece that just was not well thought out. And so, of course, there's still going to be, it's like you're taking the bullwhip effect and you're compounding it with another bullwhip inside the middle of the bullwhip. It didn't make any sense to me.
Right. Well, you're right. It's because people can see the ships off the Port of LA and be like, oh, that's a problem. I can see these. And so let's open up everything 24 hours, which they were never able to do, by the way, because of the labor shortage. But even if we get it through the docks, well, we don't have enough chassis. And then if we can't get off chassis, we don't have enough rail cars. We can't get off the rail cars because we don't have enough warehouse space. We can't get it out of the warehouse because we don't have trucks to do delivery. People are, the thing with the 24-hour port operations, that was like, okay, I'm going to run through this red light. But then there's 5 more red lights after it. And so you're still not really closer to where you're going. But I mean, look, they tried to help. I usually tell my classes, look, the government is like a 3-year-old who wants to help you cook dinner. I have kids at my house, and when when my daughter was 3 and she'd want to help me cook, it was really nice and it was really sweet of her to try, but it wasn't super helpful. It wasn't super helpful. Now our heart was in the right place and it was good, but it's like, yeah, pour the flour in. It's, at least they're trying, I guess, is what I would say.
But that expression about the road to hell being paved with good intentions, no?
Yeah. Well, it's train tracks to hell right now, I think. So Ryan, hopefully that answered your question. So one of the last pieces we're gonna show you here before we get to future predictions is every month we split out upstream and downstream costs. And I apologize. This says October. This shouldn't say October. This should say December. So sorry about that. Let me fix that. I'm not showing you 3-month-old charts here. So, and I think this is interesting. So upstream would be non-consumer facing firms. So manufacturers, 3PLs, wholesalers, etc. The orange bars are downstream. So this is like retailers, people that are interacting directly with customers. I think it's so interesting to look at, because we're talking about this bullwhip effect. Right now, or last month, basically downstream inventories basically stayed steady. We're selling stuff, bring stuff in, sell stuff, bring stuff in, where you might expect it. Upstream was a 68. That's a really high level of growth, especially for December, when you would think the suppliers are getting everything out of the system and sending it down to the retailers. Their inventory costs were also very, very high, 87. You can see we looked at, we did some statistical tests. Is there a difference between upstream and downstream? And there was a statistically significant difference for everything other than transportation utilization. And we also saw, okay, if inventory is higher, we also saw much lower capacity upstream and much higher costs upstream for warehouses. Now, it was flipped for transportation, which that kind of makes sense too, because that's last mile delivery. That's why it's happening. I like to show you this one because it's so dramatic, the sort of differences between upstream and downstream. What's funny now, because I ran the preliminary results for January, there's no difference. There's no difference in inventory levels, but it's like, 68 downstream and a 72 upstream. They're both very, very high. And this is, it was funny because last week we thought, well, maybe it's, the JIT versus JIC thing where the retailers are going to stay JIT and they're going to keep all their inventory upstream. And now it just seems like there's inventory everywhere. But again, it's only certain types of inventory. It's inventory at large retailers, not electronics, like apparel, footwear. Some of these industries, we are seeing some inventory come in. Automotive, appliances, we're seeing very, very little come in. And I think this upstream downstream comparison sort of really shows the pattern of things going through the supply chain, and suggests that, basically they had a Sophie's choice. Companies had a Sophie's choice before the holidays. It was, do we want to miss orders or do we want to have too much inventory on hand? And no one wants to miss orders. So they took door number 2. And now we're starting to see the echo effects of that come through in these really significant inventory levels. I mean, we showed that inventory level graph a minute ago, and the curve is going up like this for inventory levels. And it's because of this and because of the choice companies had to make around the holidays. All right. So if there's no other questions, we can get to the future stuff. You want to do that, Steve? All right. So here's our future predictions for January 2022. And again, this comes from a few hundred folks who took the survey over the next 12 months. And this is interesting. And I think this gets back to the question that Maria asked a little while ago. And Maria, you said, there's new facilities popping up everywhere. What's that do to capacity? Here's what we think is coming over the next 12 months. And there's new facilities coming up everywhere. And we're going to just about keep our heads above water a little bit. We're going to be at a 51.3. And there's some variability in these numbers. It could be up to 55 or, it can move around. But we've been in this sort of low 50s, mid 50s range for the last 3 or 4 months with our future predictions, which makes me think it's pretty solid. And that tells us we are going to add space. It's just we're not adding space that quickly. Transportation, there's a little more capacity predicted to come on. We're 58. that's like a good solid level of capacity growth. It's just, again, like we said before, if you're starting off behind by 2 or 3 touchdowns, then solid capacity growth isn't really going to do it for you. And that's reflected in our cost numbers, 86, 84, 83. Those are very significant levels of growth. Those are very significant levels of growth that are predicted. Now, it's not where it was. We were most of last year in the 90s. So this is a slower rate of growth. And eventually you do think that you start to butt up to the limits of what people could charge. I don't know, that Maersk has been thrilled, and really every ocean shipping line has been like, they had as much growth in the first 10 months of 2021 that they did in the 10 years before that. You would think that eventually we're going to hit a wall where we can't just keep paying these crazy numbers. But as long as capacity is down here, as long as capacity is contracting and not growing that quickly, we can expect for costs to remain elevated. Now, eventually, will we hit a point where we burn through what consumers are willing to pay? I think we can. And it's funny, if you look at consumer savings were really high. Like last March, when we were kind of reopening everything, consumer savings were up like 20-25% from where they had been at the beginning of the pandemic. Now we're back down to almost exactly where we were pre-pandemic. And so kind of we had all this extra money in the system. Stimulus checks are done, enhanced unemployment, child tax credit, all that stuff's expiring. I do think you will see a less robust consumer growth this year, and that could temper some of these. But the way consumers behave in terms of e-commerce, all that stuff, that's probably not going to change. And so it will remain a challenge as long as capacity is sort of existing down here.
The thing too, Zach, is I remember the first 2 or 3 years of us doing this, we were at a conference, I don't remember which one, and we compared what the predictions for a particular year were with the actual data, and consistently they were across the board 2 or 3 points off.
Yeah.
So, going back to the power of the crowd, if we're thinking about, and if you end up wanting to arbitrage something, this might be the slide to do it, because they historically have been remarkably close, within 5 points across the board. So what this tells us is that, that gap between the capacity on warehousing, its utilization, and its prices is continuing to be problematic. And the same thing is true of transportation and so on and so forth. So,
Absolutely.
Maybe they'll be wrong this year. Who knows? The past 5 years they haven't been, but.
So we got a couple questions here. I'll do Rosemary. We'll look at yours here. So you said, do you anticipate with the excess of inventory dropping a cost to move excess out? Yes. And we are actually already seeing that in some places. That it's getting widespread when there's stories on the local Denver morning news that mostly just wants to talk about cute things dogs did or whatever. But they had a story. Yesterday, I think, actually, about sales at sort of department stores and things like that, because there's too much inventory in the system. And after as much as you pay to get all this stuff over here, you really then don't want to pay to have too much inventory. And so you do see some people unloading it, and some of them, I think, are just accepting, look, this inventory is a sunk cost. we just got to get it out of here. So that's definitely happening, Rosemary. Now, again, it's only in certain industries. In other industries, they would kill to have too much inventory. But for some of these, especially, I think the ones who overordered, you are going to see some deals as they try to right size their inventory. And that's really all this is. There's been so much debate this year about, is JIT over? Is it just in time, or now is it just in case? JIT is not over. It's what it's always been. Companies are trying to have the right amount of inventory. And that doesn't mean you always have too much or you always have not enough. It means you read the tea leaves and you figure it out. I mean, the reason Toyota was the #1 automaker, in terms of sales in the US last year for the first time ever, is because they overordered semiconductors. And again, this is Toyota. The company we talk about when we talk about JIT is Toyota. And they were better than both Ford and GM last year because they went away from that strategy. It's not about, is this strategy good or is this strategy good? It's about, what's the right strategy for this time. And now we see companies, okay, let's run inventories back down again. We don't always want to be running at 110% or Walmart 11.5% above normal. We want to be at whatever the market says we should be at. So that hopefully that answered your question there, Rosemary. Wayne asked us, with ships being rerouted to other ports, due to problems at the West Coast, is there a potential that added warehouse capacity will be in the wrong location? Actually, Wayne, what's funny about that is it would actually make it easier for warehouses and especially trucks if we saw a bigger volume coming through the other ports. Now, though, even if we really start coming through, Portland and New Jersey and Savannah and all these places, Charleston, we really would need to ramp it up for it to make a significant dent in LA and Long Beach. But it would be great if we could. I saw a number. I was looking at some spot rates on freight waves earlier this month, and I saw that right now from Dallas to LA is about a third of the cost of LA to Dallas for dry van. And I thought that was really interesting. And normally you would expect there to be some difference, but 3 times is a huge difference, and it's because of all of the stuff coming out of Los Angeles. And then you get out of LA and it's like, well, there's nothing that needs to go back west. And so a lot of the trucks especially aren't positioned correctly. And so you have deadhead loads or really inefficient LTL going back, and basically everyone's just rushing back to LA Long Beach so we can get the really good stuff and come back out and make the money, right? And so you see a lot of capacity has been pulled away from the places where we really need it. And so actually, Wayne, if we were able to really get significant amounts of freight coming in at the other ports around the country, capacity would actually be in a better place because it wouldn't be because right now the port of LA, it's like a black hole, just sucks everything towards it. It would be great if we had some other centers of gravity to sort of distribute that capacity across the country.
Rebalance the system.
Exactly. So Wayne, hopefully that answers your question. And by the way, I guess we're through the presentation. And we're happy to take more questions. One thing I do want to say is the new LMI reports go up the first Tuesday of every month at the-lmi.com. So that means this Tuesday, the February report will be coming out. So I need to not have any weekend plans. My goal actually is to finish this before I watch the 49ers beat the Rams one more time. That's what I really want to do. But I don't know. I don't know. That might be an ambitious goal to have it done by Sunday afternoon, but that's the plan. Yeah, Steve, I don't know if you have any closing comments or if there's any questions, but we're happy to answer some.
Nope. Good on my end. Thanks for having us, all 3 ISM chapters that did.
Yeah, this was great. And I apologize. I didn't write the other one. Ryan, I'm glad it was, thanks, Ryan. I appreciate that. And thank you, Pamela. What was the other one, Kathy? Because I should put it, I'm happy to share these slides with people. I had ISM New Jersey and ISM Denver. What was the third one that was here?
Actually, we have quite a few chapters that join the programs now. We have about 10 of them now.
Oh, we had 10 of them. Okay.
10.
Then,
10 of them.
I'm just gonna put ISM on the cover then.
Probably your best bet.
Great.
Yeah.
Great. Well, thank you both for joining us today. This was very informative. I love the future outlook of what you presented as well. That gave everybody a taste of everything that's going on. If anybody, can they be a part of the report? How can they join?
Yeah, absolutely. So if anyone wants to be added to the mailing list, please send us a note, or if you think that you want to participate in our respondent board, send us a note and we're happy to add you, talk to you a little bit and add you to that. And I want to thank you guys too for having this at the exact right time where it has really kind of showed me that I need to get a curtain in this room because I've just been getting blasted in the face by the sun for the last half hour. So it's nice to talk to some people on the East Coast when this would happen a little earlier and I could find that out.
Oh, well, thank you both for joining us. Thanks for all our attendees for joining us as well. And as I said earlier in my chat box earlier today, we will be sending out continuing education point for this particular program and also a copy of the recording. So I want to say have a wonderful day, everybody, and thanks for joining us today.
Thank you.